The United States has always been more than just a country. For centuries, it has acted like a magnet, pulling in people, ideas, talent, and capital from all over the world. But today, something different is happening. In a world filled with inflation, uncertainty, aging populations, and slowing growth, the global competition is no longer just about workers or skills. It's about capital. Money is moving faster than ever, searching for safety, opportunity, and long-term growth. And once again, the United States stands at the center of that movement. This raises an important question. Can investment-based immigration actually strengthen the U.S. economy? To answer that, we need to look past emotions and politics and focus on economics, because money doesn't move randomly. It moves toward stability. Every economy needs fuel to grow. That fuel is investment. Without fresh investment, businesses cannot expand. Innovation slows down, and job creation weakens. Even the strongest economies eventually lose momentum. When wealthy investors move to a country, they don't just bring personal wealth. They bring businesses, experience, networks, and most importantly, capital ready to be deployed. That capital flows into factories, technology, real estate, startups, and infrastructure. And wherever investment goes, economic activity follows. Think of investment as oxygen for the economy. The more efficiently it flows, the healthier the system becomes. This is the real purpose of investment-based immigration. It isn't charity. It isn't generosity. It's strategy. Here's what most people don't realize. When an investor chooses the United States, the benefits extend far beyond that individual. New businesses are created. Existing companies expand. Local workers are hired. Tax revenue increases at federal, state, and local levels. One major investment can support hundreds, sometimes thousands of jobs over time. This becomes especially important as the U.S. faces long-term challenges such as an aging population, rising healthcare costs, infrastructure demands, and global competition. Wealthy immigrants typically contribute more in taxes than they consume in public services. They rely less on social programs and often act as net contributors to the economy. In simple terms, they add more than they take. And during times of global uncertainty, that kind of stability matters. The future of economic growth will not be defined only by population size. It will be shaped by productivity, innovation, technology, and the ability to attract both talent and capital. Investment-based immigration fits directly into that future. It does not replace traditional immigration. It complements it. It allows the U.S. to attract builders, investors, and long-term contributors to the economy. More importantly, it sends a signal of confidence. When people with wealth choose to invest their future in a country, that trust becomes a powerful economic force. The real question is not whether investment-based immigration can strengthen the U.S. economy. The real question is whether the United States can afford to ignore one of the most effective economic tools available in an increasingly competitive world. Because in the modern era, economic strength is not built by borders alone. It is built by capital, confidence, and the ability to attract both. Here's where things take a turn. The United States is not alone in this strategy. Countries around the world are actively competing for global capital. Canada, the United Kingdom, Australia, and others have designed policies specifically to attract wealthy investors. Capital is competitive. If one country closes its doors, another opens them. And capital always moves toward rule of law, economic stability, and long-term confidence. When the U.S. attracts global investment, it strengthens the dollar, stabilizes markets, and reinforces its role as a financial safe haven. This creates a powerful cycle. Investment drives growth. Growth attracts more investment, and economic leadership is reinforced. In a world facing demographic decline, capital becomes one of the most important tools for maintaining economic power.